Okay, in this video, I'm going to talk a little bit about the taxation of benefits associated with life insurance policies. So typically, when you're looking at life insurance policies, the premiums are not tax deductible. Now, there are a few exceptions to that. So one exception to that is, and this was mentioned in a prior video, if you look at employer group policies that meet specified criteria where the insurance amount is within the requirements, so under $50,000 of coverage. Generally speaking, the premiums that are paid on that will be tax deductible for the employer. Um, Also, policies that are benefiting charities, so policies in which the charity is the owner and the beneficiary, the premiums paid on that will be tax deductible. And there are maybe a couple of other exceptions too, but generally speaking, if premiums are being paid on a life insurance policy, it's typically not going to be tax deductible. However, the death benefit is free from federal income taxes. So what's received at death is free. So at least for the death benefit. Um, Now that leads to some interesting other issues, which is, well, what about if there are sort of lifetime benefits or the cash value or dividends are distributed kind of prior to death, so during the person's lifetime? Well, distribution of cash value or dividends from, say, a whole life policy are typically reviewed as a return of the premiums that were previously paid, and therefore will reduce the basis for non-modified endowment contract policies. We talked about modified endowment contract policies in a prior video, um, or I discussed that in some detail, but not tremendous detail. So from that standpoint, basically the idea is as long as we don't have a modified endowment contract policy going on, then what happens at that point is if there are benefits received during the lifetime, like dividends, things like that, and that's just viewed as you receiving some of your premium back. Um, there are also some interesting rules um, for basically what a Section 1035 policy exchange. So if you have a Section 1035 policy exchange for certain swaps of policies, then a gain is deferred. So that's kind of important as it relates to the taxes a little bit. But significantly, if a policy is considered to be at any point in time an MEC, then at that point it will always be an MEC. So once a policy has been termed an MEC, there's no going back. It can't be changed into a non-MEC policy. So from that standpoint, you want to make very sure that you don't trigger those criteria and turn it into an MEC policy unless that's what you desire to do. If you look at terminating a policy while the insured is alive, that could possibly trigger a taxable event. And so if, for instance, you have a whole life policy, you terminate it and cash out, that could trigger a taxable event at that point. If you do something called a transfer for value, then you can lose income tax exclusions as well. So if you start doing that, where you're transferring the insurance policy for in exchange for a value, then that can lose lose the income tax exclusion as well. That brings us to kind of a similar idea, which is life settlements. So for a life settlement, this would be a situation in which a life insurance policy is sold to a third party for more than the cash surrender value. So what the insured person would get if they surrendered the policy to the insurance company. So it's sold to a third party for more than that, but less than the death benefit. And basically what's kind of happening here is the insured individual is selling the policy to a third party. The third party is basically paying based on their assessment of the mortality risks associated with the individual. And so let's say the cash surrender value for a policy was $300,000, death benefit is $1 million, and the policy is sold to a third party for $400,000, something like that. So that would be the idea behind a life settlement. And so that would be something to be careful with for tax calculations and evaluate that situation carefully. Interestingly, if the insured individual is terminally ill or chronically ill, there can be some interesting things that come into place as it relates to income taxes and taxability. So if the individual has 24 months or less life expectancy, then what that can actually do is if the person is receiving payouts in advance or sort of in anticipation of death, then they may not have to pay income taxes. So kind of the idea is the person is receiving the death benefit, but a little bit early, but it's sort of in anticipation of death with life expectancy being 24 months or less. And that's where you get to kind of the idea of accelerated benefits provisions or riders. So basically saying if you're diagnosed with a terminal diagnosis, they can essentially accelerate the payout early. And then the insured person could receive the money and perhaps use that to cover costs of medical expenses or things like that. Um, and that's kind of where we get to the idea of what are called the viatical settlements. And basically, for it to be a viatical settlement, that's basically a situation in which the insured person is essentially selling the policy prior to death. So they sell it. They are terminally ill, chronically ill. So it's kind of in that in anticipation of death kind of a situation. And the person sells the policy to a qualified viatical settlement provider. And basically, if it is a qualified viatical settlement provider and they sell it early, um, then that would generally mean that you could avoid taxes on that situation. Okay, hopefully this is helpful, and thank you for watching and have a great day.